G'day everyone, welcome to this rundown for global stocks and commodities for the 10th of September. This week I'm going to focus on gold for obvious reasons because it's started a pretty good run. The question is this just another short-term run up to resistance and then we're going to sag back, or is this the start of something with a bit more significance? The reason for gold's strength in the last few weeks has really been a perfect storm of several factors coming together. So we want to take a look at that. So in this update, just before I start, I've been doing these weekly videos now for a decade, and I get a little sprinkling of feedback, but not very much. I can only assume that because there's a whole bunch of people who watch them, that obviously there is some value in the weekly videos. But I don't know whether there are things that I could cover that would be more appropriate, or would be of more value to people that are viewing them. So I'm going to ask you just if you could complete a very short survey. The link's in the description below. I know doing surveys is a bit of a pain, but it would really help me to help you if I have a better understanding of the sort of material and content that you're looking for. It's only 3 really quick questions. It won't take you hardly any time at all, and it would really just help both of us. So in this update, I'm going to be looking at obviously where to for gold from here, what the key indicators are, and the levels of resistance and support that we should be looking at, both for trading gold and gold stocks in the short and the longer term. So and of course, looking at the other indices as well, it was a bit of a week of indecision. Really, we're still stuck in this range. So obviously looking at all of those normal global indices and commodities as well. So let's start first of all with American stocks. The S&P index was 16 points lower on the week. And the range is in force that I've been talking about. We had a few mild volatility spikes, but I've been saying now for a while that the most likely outcome would be that we would just go into some sort of trading range for a period of time. August, September, typically seasonally is a bit weaker. But there's so much strength behind the market that I really thought a sideways reaccumulation before the next push higher would probably be the outcome. And at the moment, I see nothing to change that view. The best performers in the US market are clearly stocks related to China, particularly technology stocks. Biotech stocks in America have had a good run, and of course members are well aware of one in particular that's done extremely well for us, up 13% just in the last week. And there's been a few selected industrials that we've been able to capitalize on as well. So they're the areas of the US market that are leading at this point in time. Banks are weak, and they're weak in Australia as well, and that's because the pace of the rise in interest rates that everyone was expecting would be significant now appears to be dwindling and to almost nil. And so the premium that was in the bank stocks around the world is now coming out of those stocks. The other big thing, of course, was the breakdown in the US dollar. It brought quite a significant breakdown, and looks to me like there's further room to the downside. So that's keeping upward pressure on the Australian dollar, as crazy as that may seem. It's hard to see that that's going to subside in the very short term. So let's take a look at the American market first of all. So we'll start with the S&P, and you can see this was last Friday's close. Here, that little green doji candle. We backed off a little bit, but you can see, other than Monday, where there was a little bit of moving around, and that was just largely related to what North Korea did over the weekend. So that was just a bit of a reaction to that 4-day trading week in America. So that was the Tuesday session. But then since then, you can see really small ranges on the day, and a little bit up, a little bit down, and a little bit neutral. So the market really has no direction at the moment. But at this time of year, given what's happening with with Trump and his popularity and his inability to get anything done, with North Korea in particular, I just really read this as a sign of strength, that the market just can't get enough momentum to the downside. So I see this as a positive. Let's just look at it on a bigger picture view. So this is the last 35 years that you're looking at there. Peaks in 2000, 2008, and now we're getting this this massive extension of the rally. But I'm not one that buys into this argument that because the rally's been going for 8 or 9 years, then it has to end. I think that's a stupid argument, and it's one that you should ignore. At the moment, it is still up, and there is no end in sight, no matter which time frame you look at, whether it's monthly, weekly, or daily. So that's the S&P, and we may see a continuation of this for a few more weeks yet. So previously I indicated that we had support in this area here, 2400 to 2410, and that if that were to give way, then we would be looking at support between 2350 down to 2330. At the moment, we haven't even really seriously tested this higher level. So as I keep saying to you every week, trade what you see and not what you think. And at the moment, the market is saying that it's not really going anywhere much to the downside. Now, the Nasdaq, of course, has been leading the way, and this is the QQQ, which is the ETF that tracks the Nasdaq index. And these are the questions that and comments that I've posed over the last month or so. So just some notes up here. Clearly, there's a change of character. If you look at this period through here, it was a strong uptrend, stayed well above the 50-day moving average, hardly any significant red candles. Range is fairly small, just the odd red candle here and there. But once we got to here, which was the 9th of June, we started to see more of them. And you can see that this is just starting to flatten out a little bit, getting a bit of an excursion below the 50-day. It's nothing dramatic, but it is a change of character. So we're getting some. You look at the volume spikes. Look at all these red volume spikes through here. There's a lot of them. We didn't see any of those back here. So clearly the market has changed character. There's no question about that. But that doesn't mean that the market is going to go, that we've got a top and that the market's now going to go into a bear market. What is entirely possible is that we get what's called a reaccumulation phase, where the market goes sideways for a period of time. It reaccumulates some momentum. The fundamentals catch up to the price, and then eventually the market is in a position where it can move higher again. So the possible outcomes were a reaccumulation range. I thought that was the most likely, and that's the way it's turning out. It could have been a complete breakdown into a bear phase, so the end of the 9-year bull market. That there's absolutely no sign of that at all. Or it could just be a decline within the overall uptrend that would bring us back to the 200-day moving average down around this area down here somewhere. Now, clearly, alternatives 2 and 3 don't appear to be unfolding, so we're still left with number 1, and it's a reaccumulation range until otherwise advised, and that's how you should trade it, and that's how you should position yourself in the market. So the bullish signs, candle ranges get smaller. We're starting to see a bit of that now, despite what North Korea is doing. We had a big red candle here. We got a couple of candles here. We got some elevated volume spikes. But look at the volume spikes now. The volumes are tailing right away. So the selling is drying up. That's the only way that you can interpret that. So the candle ranges are getting smaller. The volume is being reduced on the declines. And we're getting higher lows within the range. So these are all indicators. So there's our trend through there. It's quite clear. So there's no other way to look at that chart but in a relatively stable to bullish fashion. Let's just check in on what the small caps are doing. This is the Russell 2000. We're in a range. The small caps are showing weakness relative to the rest of the market, but not dramatically so. The market breadth is still reasonably solid. So I'm not seeing anything that causes me concern here in the Russell. We're back to the halfway point or just above the halfway point of this big range that started in December last year. So nothing untoward in the small caps either. Now let's look at the VIX index. We've had a couple of little spikes over the last month or so. This is the first one here on the 10th of August. But since then, just the odd spike here and there, and a lot of these are just around North Korea. But basically, the market is ignoring that on a comparative basis. I would have expected, given what's going on with North Korea, to have seen excursions up here into the perhaps to the 20 on the VIX, but as you can see, that hasn't occurred. So the market's remaining fairly calm. Now let's turn to the US dollar. So this is the big picture we've been looking at. The left-hand side of the scale here is May 2014, so we're looking at getting up towards 3.5 years. We had a very clearly established range between 92.5 and 100. We broke above that in November of last year, peaked out at about 104, and then since then it's been sharply downhill. This has been a very sharp decline. Now this was important support, and we did bounce off it, but it was a pretty weak bounce, and now we've broken it. So a key support at 92.5 has been broken. However, one thing you will notice, apart from the fact that the US dollar is now significantly oversold, is that, and this is a bit of a characteristic of markets over the last decade or so, with so many computer algorithms around the place at the moment, is a lot of markets tend to display this broadening top formation over a long period of time. So if we stick a trend line through here, just extend that one back through there. And this is a bit of a function of the computer algorithms that are programmed to overrun the previous lows by a little bit. So this low overran this low by just a little bit to basically run the stop losses that traders would have just under the market. Here it is again, this low, a little bit lower than this low, just enough to throw the sucker punch at the market, trigger the stop losses, draw people into the short side, and then immediately reverse, and the smart money pushes it back to the upside. Now, if this pans out again, then we're looking at a little bit more downside, not a great deal, and we did get a bit of a reversal on Friday night, but you can see that we could easily get down to around the 90.70 mark, which would be about another 0.4. So still a little bit of room to the downside. Now there's another key support down here. If this level fails to hold, there's another key support at 89.5. If that breaks, then we've got a serious decline on our hands if that one breaks. So that's the US dollar. But so far, it's been a very, very substantial downtrend. You can see the orientation of the blue 50-day moving average, and also this is the pink 20-day moving average. You can see that they're both strongly pointing to the downside, and the price is below both of them, which means that we've still got strong momentum to the downside. So as we do on the upside, you've got to go with what is. The momentum is down, and until further notice, that's the way it's going to continue. Now, the Australian dollar also managed to spike up to 81, finished the week at 80.5, and this is largely around the strength in the weakness in the US dollar and the strength in commodities. Turning now to Aussie stocks, the Aussie dollar finished at 80.5, and our index was lower by 52 points. So, we've got this situation with the US dollar where we've got a weakening, a stronger euro, and I'll come to that in the next slide actually. So the Australian ASX 200 index was lower by 52 on the week. It was only saved by the miners. The major miners are still pushing higher with commodity prices, but also the small caps are doing fairly well, and that right there is the story for Australia. I think unless you're purely dividend focused, just forget the top 50, and any progress in Australia is in the small and mid cap growth stocks. And you've got to be very selective in terms of what stock, and you've got to be very patient in terms of getting into them, because most of the time they're not at a price that gives you a realistic chance of upside, certainly not compared to the risk that you have to the downside. So the Australian market, there are little pockets, but you've got to be pretty nimble to get a hold of them. So let's just look at the Australian market. So there's the ASX 200. We're just stuck in this range now, which is, if you look at the slightly bigger picture, it's been all year. So it really started at the end of 2016. But we've really been in this lower, tighter range since the middle of May and not showing any signs of coming out of it. In fact, in the short term, we actually have a downtrend. So things not looking that attractive in the Australian market. Whereas if you look at the miners, there's our major miners, largely reflecting BHP and Rio. So obviously in short-term uptrend and even medium-term uptrend. This is the small caps. So we've come out of a range and we're heading higher again. And not that far away from all-time highs on the small caps. So that's instructive. And of course, this is the banks. Finance sector has really rolled over, and we're basically on key support. We're oversold. So that's not to say we couldn't get a short-term bounce in the banks, but the outlook is not good. Turning now to precious metals. So gold higher by $35. And it didn't finish at 1327, beg your pardon, I should have changed that. It's actually 1347. It was the third successive week of higher closes, and really the perfect storm is North Korea, of course, the geopolitical fear factor in there. The actions by the ECB on their policy on stimulus has caused the euro to strengthen, which has put some added pressure on the US dollar. And the third factor, of course, is Fed policy has shifted from 3 interest rate rises this year to 1 and possibly none. And that's bought some of that premium that was in the US dollar, that's bought that out. So all those factors are contributing to the higher gold price. GLD holdings, interestingly, didn't move much during the week. They're only up 3 tons. So money's certainly going into gold in the futures market. There's no question about that. But it's not really being reflected in the physical market in ETFs, and not that fantastically well into stocks either. So that's why at the moment I'm seeing this as still a play in the futures market. Now it's a strong one. But bull markets in precious metals are not sustained by future speculators. They're just not. The amount of money is too small relative to the whole, and future speculators are so highly leveraged that any little blip to the downside causes them to flee. So you will never get a bull market sustained in the futures market. You need the broader support of the ETF market, which is where the investors go. And also that then gets reflected in the stock prices. And, we're not really seeing that enthusiasm in those other areas. So the precious metal stocks are positive, but they're not really being fully embraced at this point in time as I see it. So let's take a look at precious metals. We'll start first of all with the big picture on gold. So this is a weekly chart. Here's our peak in 2011 at just under $2,000 an ounce. Now, a very clear downtrend was formed, and you can see the price was way below it. But if we put a Fibonacci scale on this from the very lows here in December of 2015 all the way back up to the high, then we get a 38.2% retracement at 1377, which is exactly where the price went to. So, you can't tell me that markets don't respond to these technical levels. So went exactly to the 38.2, backed off more deeply than I would have expected. But there were a number of factors around that. Most largely the fact that the Fed looked like they were going to raise rates a number of times, which made gold less attractive. So that caused that last little bit to the downside. But now we're breaking out. You can see we've broken that long-term downtrend line. So we do have a breakout. However, at this point in time, we haven't broken above 1377, so that's the first key level. And then the next key level is up here, coming off these peaks in August of 2013. So that is at about 1430. So we need to break, first of all, 1377, and then we need to break 1430. Now, once that happens, then you open the door to significantly higher prices. And I certainly don't rule out over the longer term gold returning to $2,000 and above. I have no real idea of when that might be, but I'm inherently reasonably confident that it's going to happen. But look, it could be 5 years, it could be 10 years. So I certainly wouldn't position yourself on that expectation at this point in time. Let's just zero in a bit on the daily, and you can see it's been a really strong run since the lows in July of this year. We went up, we paused around this triple top for about 2 or 3 weeks, and then we broke out with a fair amount of gusto. It's overbought in the short term, so I'm really expecting to see a pullback. We might advance to 1377, particularly if North Korea fires another missile. But as I said earlier, the futures market is not going to sustain this rally, and at the moment, that's the only place that I'm really seeing strength. So that's why I'm not convinced about the strength of this particular rally. Turning now to other commodities, copper went up to $3.13 and then eased back to finish at $3.02. Possible short-term top, but there is certainly a lot to like about the fundamentals of copper, and this has been a strong rally. So I think in 2018 and beyond, we're moving into a significant deficit in copper that's being caused not by a spike necessarily in demand and demand outstripping supply. It's the other way around. There's been such a long period of underinvestment in copper mining that it's actually becoming a supply side issue now, which is you tend to get much stronger rallies out of supply side issues than the other way. Crude oil, 47.48, didn't really move much on the week. Energy stocks bouncing around a little bit. They had a good few days last week, but then did pull back on Friday. So again, I'm not convinced about energy stocks as yet. There's the spot copper chart. You can see the sharpish pullback on Friday. And there's crude oil. I've expanded this out a little bit. This is a 6-month chart. We've been looking at 3-month charts of late. But you can see that we're really in this range between 44 and 52, possibly up to 55, and that's the range we've been in. We're sitting in the lower part of that range at the moment. So to wrap it up, this is the point I made last week, which I think is just so valid. We're in a period of uncertainty for a number of reasons. How do you play it? Well, look, you've just got to put out of your mind what you think should be, or what someone else, some guru tells you is going to happen. Let the price action be your guide overwhelmingly. And the second thing is, and I know I keep banging on about this, not every week, but multiple times a month, and have done for years. And strangely enough, it's the most important thing that you can ever possibly do, and that's gain clarity of purpose about what you're doing and the process that you're using to achieve it. Yet, in my experience of working with literally thousands of traders, it's the one that most people resist doing, and I just can't wrap my head around why that's the case. But I offer it to you again as the single most important thing that you could ever achieve. Clarity of purpose for each transaction, short term, medium term, high risk, low risk. They're the key things. Whether it's dividends or capital gain, just be clear about what you're doing with that particular transaction, and then secondarily, what are the steps you are actually involved in that process. How are you going to buy, and why are you going to do it that way? Why is that a low risk point to entry? What does it look like if the trade fails? So what's going to be your trigger to tell you to get out? And you need to determine that in advance. How are you going to take profit if it turns out that you get into that position? What are going to be the things that are going to tell you that it's time to take profit? So these are the things you need to think about before you enter. Now, this week in Portfolio Analyst, I'm going to be focusing on the methods for identifying the two major trading opportunities. So there are only two types of opportunities. One are what traders refer to as swing trades. Ideally, swing trades within a range that's highly likely to be a range and not a breakdown of some sort. And then the second thing is, so that's basically buying low and selling high. And then, of course, the second major opportunity, and this is the ones that are absolute gold, and that's identifying the early stages of a major upward trend. If you can get accomplished and skilled at doing that, which is what I'm going to be teaching in Portfolio Analyst, then that's the most valuable skill that you could ever have. So that's going to be the focus of Portfolio Analyst this week. So that's it for this week. There's my contact details. And look, just another reminder and a request. Help me to help you. Just take a minute or two to complete the survey. Give me some feedback, and I'll be able to provide information that's of most relevance to you. That's it for this week. Cheers.